Welcome back to the last word. Oh, hate that. Welcome back to the last word. It's Friday. Hello, Jodi.
Hey, Brian.
Thanks for joining us.
Absolutely. Happy to be here.
Yeah, so this is, I think, episode 3 of our little last word show. Christy Suk joined us last week. Super excited to have you on this week. The voice of KP's out there somewhere. Say hi, KP. Okay,
I'm
he's on
here.
mute.
Can you hear me?
Loud and clear, my man. How are you?
Welcome, Jodi.
Hey, how are you, KP?
Doing good. I think all three of us were together last at the Let's Accelerate. I know Brian was there. We're shooting our
I was
promo
there.
video for last.
I
For the last
wasn't
word.
there. I missed you.
You missed us. Okay, well then I miss you.
Jodi and I were together at the
yeah.
same place, but didn't see each other a few months ago.
Yes, we were last at the Kentucky Derby together, but not together.
Yeah,
Nice.
so crazy. All right, well, let's get into it, guys. There's it seems like these weeks are packed with news items, right? And I think we want to just dive right in and start tackling these. There goes KP off our screen again. KP, you make it hard to be a co-host, my man.
Don't be mad. I'm not trying to draw any attention. You're talking. Keep going. I got you.
So, Jodi, what we've been doing is just kind of talking about, the key issues, key items of the week, and then, just doing a little, little riff on thoughts, opinions, trying to stay out of the political controversy as much as we can, but it's going to be tough to do that, I think, at times. But let's start with the news of the day. KP, what do you got for us as it relates to the numbers we saw released this morning?
Well, I think the PCE is obviously, it's a huge data point, and I know it's like a great fun parlor betting game to talk about, when the Fed's going to cut and this and that. But we've been talking about inflation for years now, and so just a real quick crash course. The personal consumption expenditure (PCE) came out today. It is the Fed's preferred gauge of inflation. It's actually called the Fed deflator. And so it's more like real-time expenditures for consumers, what they're spending their money on. And so just a quick little breakdown. It came in at 0.1% up month over month for June, and then 0.2% if you exclude food and energy. That means food and energy were down and brought that overall number down. We know the gas prices have been coming down a little bit. And people are, when you get in, I don't want to use the R word too much, but when you get into recessionary type feelings of consumers, they just don't drive and fly as much. And so, then, regardless of what, gas prices are doing, they're just not biting. And usually June is the biggest travel month of the year when it comes to gas consumption. So anyway, 2.6% PCE core, right? The one that excludes food and energy. And the 3-month average for PCE core is like 2.3. So we're really close to 2%. The 40-year historical average for PCE is 2.4%. So we're never at 2%. So the real problem is labor. Okay. And so there's actually some labor data that's out this week, which I think kind of goes together with this. And so I know there are a lot of people saying that like inflation was going to run forever and the 10-year treasury would be at 6% and we would be at 10% interest rates. Those guys were all wrong. They're all wrong. Okay. So just beware where you get your information from, because there are people that take, extrapolate data to like the extreme, like it's just going to go on forever. And it just doesn't work like that. These things take time to work out. The first quarter was tough. We had a little blip in inflation, but the wages are the big deal. So wages only went up 0.2% month over month. And if you adjust for inflation, it's only 0.1%. That's pretty scary. I had a great conversation with Chad Gamal. He's over at RHMI to spend a few days with their team learning about a lot of stuff. By the way, I won the long drive competition. You can see that, just saying. Nice little crystal thing. I know it doesn't really mix well in front of the thing.
Was it from the Red Tees? Were you with
It was
Bryson
junior. It was
DeChambeau
junior
from the
golf
Red
league.
Tees?
Junior golf league.
it was at Whistling Straits of all places. Beautiful. Arch is a great partner of the industry. They actually have a non-QM conduit. Just thought I'd throw that out there. Anyway, I had a conversation with Chad, and on the way back, he was nice enough to drive me an hour both ways to the airport. And we're talking about stagflation. Stagnant means there's no growth. And with GDP out this week, at 2.8%, there's clearly growth. Even if, 1.9% of its consumer spending and the rest is companies building up inventories. Under 2% GDP is contraction territory, and we weren't there. So we still have growth. We don't have stagnation in the economy, and we don't have inflation because inflation keeps coming down. So now, if the Fed keeps rates higher for longer, we keep crushing small businesses and people start losing jobs and wages don't keep up with even the low rise in inflation that we still have, that's where you start to see slowing growth and potential stagflation. So he's not wrong to talk about that and be aware of that. So this is what a soft landing looks like. And, I think it's time, for the Fed to cut the rate. They probably won't do it next Wednesday. They need the cover of the dot plot that they don't get until the September 18th meeting. They need everyone to go out there and show what they were thinking, because they don't publicly talk about, all the conversations and everything. The only thing you really see behind the scenes is when they put out the dot plot, which is the SEP, the Summary of Economic Projections. And they do that every other meeting. So that doesn't come this meeting next Wednesday. They need that cover for all of them to be like, well, 12 weeks went by and things have changed. And yeah, I was really hawkish before, but now I'm ready for a cut. So anyway, if you want to see what the market thinks, look at the 2-year Treasury. That's really, that's a point. 2-year Treasury is down to 4.2, and the Fed funds rate is 5.25. That's 100 basis points, right? So that's where we're heading. So it's time to start getting ready for all that. Get your home equity strategy in line, get your cash out refi strategy in line. Those borrowers that just could barely qualify, get them on, get them in line, let them know, it's coming. It's going to come. And so that I think is the headline and the last word of the week as it relates to PC.
Hey, Jodi, I have a question for you, because you and I are in we're in similar spots. We're not in the day-to-day origination. I've been away from it for a little over 5 years. And so I'm getting a lot of my news from, KP walking around a couple times a week at night, being kind enough to share his expertise and knowledge of the markets. But I talk to a lot of lenders, I talk to a lot of originators, and I gauge things by the sentiment of their tone. And I'm feeling some more positivity in the conversations. I'm curious if you're kind of getting the same vibe in the conversation.
No, I absolutely feel the same way, that there is optimism, but there always is optimism. My question is, KP, how much of the spending that is happening is driving people further into debt? I saw some crazy statistic that individuals are willing, something like 40% of people are willing to go into debt to go on a summer vacation. What I will say about that, KP can answer about what he thinks on the data part, but I think that means hey, all you lenders out there, get your cash outs ready, get your home equity lines of credit ready, because as it starts coming down, paying your credit card bills at 20-30% interest rates, that'll be the first place that consumers are looking to catch a break.
Here today, gone tomorrow. Tomorrow's not promised for us on this planet, nor is our money. So you can't take it with you. So you're making memories, right? So I can't hate on that. Yeah, credit card debt is pretty high. Delinquencies are high. Well, credit card debt being high itself isn't a bad thing. Who uses cash? Less than 10% of all transactions even use cash now. So, I would, not that I chew gum, but I would pay for a pack of gum with a credit card because I want the points, I want the miles. So, it's who uses cash, right? But it's the delinquency part that's a problem. And the delinquencies are very high. They're at some of the highest percentages they've been in years. And that is a fear. And unfortunately, I've been talking about this my whole life. That's why I work so hard, is the haves and the have-nots. Look at Europe. I mean, either you own property and you're rich or you're not. There's no middle class.
Yeah.
So, this country in America has a widening wealth gap. And so if you are among the poor or the lower socio-demographic, areas, you just don't have any money. And this is really, really tough right now. Really tough. And I think that's where the doves on the board are looking and saying, we got to have cheaper credit card expenses, cheaper car loans, cheaper money, more money flowing so small businesses can hire people that they might not necessarily hire at this moment to give someone a job. Obviously, the most, deflationary force is people being, unemployed. And so being unemployed but still going on vacation is a bad call. Savings rates are down. So, it's a tough time for, the lower end, unfortunately. And but you'd be amazed at what can happen when the Fed starts cutting rates. If money comes back into the system, the velocity of money, cheaper money, businesses, will take venture capital will take shots at smaller businesses, that have a promising idea that doesn't make any money, which hires people, and some of those end up working out. And the next thing you know, you've got an Amazon with tons of delivery drivers. That is, of course, until Waymo automates the hell out of their own drivers. But, innovation is a very deflationary force. And I think over time, we're still in a very good spot. But the flow of money coming in with Fed cuts is a big, big deal.
I don't know if you guys caught the show. I think it was last week, The Big Picture, which is on the same channel here it's our sister show, I guess, hosted by Rich Swerbinsky or co-hosted by Rich and Rob Chrisman, who's our gracious host for this show. They had Stan Middleman on, right? Stan I thought the show was incredibly deep in conversation. They covered a ton of ground. But Stan said something that really stood out. He said, I'm sad it's cloudy, but take my word for it, it will be sunny soon, right? So if you think about mindset, that was like such a great statement. And they were talking about the cycles, and Stan kind of talks a lot about the 8-year cycle. And if you chart things out,
especially if the Phillies get in the playoffs and win the World Series, then it's right?
That's a totally different harbinger of good fortune for our industry. But I'm encouraged when I see leaders like Stan. I think KP, you continue to bring positivity. Greg shared this morning, had a great post kind of highlighting the news that came out, the chart, and bringing some positive energy. I think all that stuff is just so important for the mindset of our team on the streets in the field, because their vibe, their energy is going to feed off of the consumers as well. So, all right.
And just on that note, I just want to remind everyone, rates have been getting better since October.
Yeah.
They were just at a 5-month low 2 weeks ago with the CPI report. Rates are at a great spot. The 10-year Treasury is at 4.2, may break below that after today or going into the Fed meeting next week. Rates are trending down, and that is what drives our business. Obviously, the volume. And so, I know we're in a seasonal slowdown, but man, you got snap. If you're not happy right now in the middle of summer, I got nothing for you.
All right, I want to shift gears, although it's with what we're talking about. So, big news of the week: Mr. Cooper announced they're acquiring the majority of the mortgage business from Flagstar, my old stomping grounds. And so I looked at that. I look at that as another positive signal for some really smart people that see some things coming down the road as it relates to retention, recapture, refinance. Your all's thoughts on the acquisition, or the announced? I should say the announced acquisition.
The announcement. Just the same strategy play for the decrease in interest rates and really being able to jump into the recapture position for those loans. So not surprised. I I think that we will likely see more of that when people are in a situation similar to Flagstar on a smaller scale, and having groups that are better positioned to make more profitability on the loans, just by having the decrease in rates and having a really well-oiled machine to get through them quickly.
KP, I know you've probably been fielding all kinds of questions and other
Yeah,
inquiries.
let me give you the spectrum of thoughts here, right? And so, but just let me start with my thoughts real quick. Mr. Cooper's a great company. I mean, fantastic company. They have some roots going back to CTX, Syntex. There was a lot of recapitalization after the crash, and they're a survivor. And I haven't personally met their CEO, Mr. Bray over there, but they've done some acquisitions like this in the past. But I don't think past is prologue. That's just my optimistic tone. We know they acquired Pacific Union and then just canned everyone in wholesale eventually, right? And so I don't think that necessarily is the play here. I don't know. I don't know them other than, we sell to them a little bit on our correspondent side. We'll sell them closed loan packages when they want to come in and participate. And so a lot of services. So that's just my personal thoughts. Now, let me just talk in general, not about Mr. Cooper. So the sad reality, okay, I'm going to start with the secondary market is cold, heartless, and unforgiving. Okay, I'm just going to start with that right there. Okay?
I've heard that before.
Yes, you guys are welcome to use my phrase. I've been using it for years. I've learned that lesson many times. The secondary market does not care about salespeople, doesn't care about the brand, doesn't care about, Flagstar is a great brand. Now, make no bones about it, they still have a local brand for now at their local branches on the banking side, which New York Community Bank owns. But the good people, you and I know the Hammond family, they're freaking awesome. It's such a great private company story that's gone through so many iterations. The secondary market does not care. They don't care about you. They don't care about the AEs. They just don't. They bought that book. Now, I haven't seen the numbers of what was it? It was 1.4 billion was the price tag, but I don't know what the size of the portfolio was and the percentage of W versus conforming. I don't know that, but I know from New York Community Bank, it frees up a lot of capital. In servicing, basically for every $1 billion you have on your book, you need to set aside $10 million of cash. Okay, think that ratio right there. $10 million in cash. Just said it. Thank you, Gary Malice, my partner, Chief Capital Markets and Strategy Officer. He gave me that little nugget many moons ago. If you have $1 billion in servicing, you need $10 million in cash. Now, if you're a bank and you're cash trapped, like New York Community Bank was, and had to build out by Mnuchin and Auding and 1.1 billion and all this, or was it 10.1 billion, something like that? I don't know. There's a whole bailout there to get them kind of recapitalized because they got sideways on the commercial paper. So they want to focus on, the rest of the bank footprint, all that kind of stuff. And this is a great way to raise cash. The prices for servicing are still pretty good. If you've got a vintage that's got a 3% handle on the front of your loan, those are sticky. So I don't know the number of the 1.4 billion versus servicing, but just let me tell you, this is the cold, heartless part. The people in the TPO and the machine and all the portal and all the things and everything that's working, that just gets thrown in. Here, take that too. Okay. So Mr. Cooper bought the book and then they get the people. Now, it's actually a very opportune time for them to want to have a channel like that, because if the Fed's going to start cutting, they can start bringing that in and feed their portfolio. If they believe in themselves as a servicer, which so many servicers do right now, they believe they're going to recapture all these refinances and cross-sell home equity loans and car loans and this and that and the other, and whatever else their revenue is on the servicing side. Now's a great time to grab a team of TPO people that are experienced like the good folks at Flagstar. I don't know if that's a long-term strategy for them. I don't know that, but that's, so typically, 1.1 net tangible book value is the most I've ever seen anyone pay for an independent mortgage banker. When Franklin American sold to Citizens Bank, there's the book value plus 0.1%, right? So people, unfortunately, the people that we all love and we meet and we know them personally, we aren't worth shit to the secondary market.
Right.
That's the cold, heartless part. Now, the flip side is that they have a good team. It is that time of the market. They are cranking right now, and they can crank for Mr. Cooper or anyone that would buy them. And if they want to aggregate loans in a TPO kind of way, they're a very, very good team. As you know, you used to run that team.
Yeah, I know the team well. They are among the best for sure. I have a thought. It's, besides the primary target, which was that book, that MSR book. I'm curious. I wonder, if there was ever a platform that potentially could go compete with the guys that are about 20 miles from me here in Southeast Michigan on the true wholesale side of the business. By the way, I've got guys on 20 miles north and 20 miles south that represent, a significant portion of the wholesale channel. But if there was ever a platform that with the, tooling and people could compete, that Mr. C might be one that could get in that game. What do you think, Jodi?
Yeah.
Am I dreaming here?
Yeah.
I think that maybe you should move a little bit south and get out of between them to the great
I
state
know
of
it's
Ohio. You
lot
can
of
join
friendly
Rich
fire.
and I. Yeah, no, definitely. I think so. And I mean, I've sold loans to Mr. Cooper for nearly 30 years now, and has always been a great partner, and has also have had a great relationship with Flagstar. So it's like you're torn, but definitely very interested to see what would happen. I did see this morning that 1,100 employees will transfer with that. I don't know what the total impacted employees are in the channel, but I did see 1,100 seems like a big number for employees that will be offered employment. And that's
Yeah, I mean,
where,
it's
my greatest empathy and concern goes, because I'm not one of the cold, heartless
yeah.
secondary market people.
I could flip my phone over and show you the threads of text that were going on, for the last day and a half following that with some dear friends of mine that are there. Frankly, they're family to me. So great people. Yeah, I think the 1,100 spans, not just the sales channels, obviously, because their sales channel all in maybe was 80 people, something like that. So I'm guessing, I don't know any of this, but it's, the operational support, the servicing business, the servicing support, and kind of all the things that circle around the edges of production. So it'll be interesting to see that thing play out here over the next 3 to 4 months.
Yeah, absolutely.
Let's see. Let's figure out. Let's shift gears a little bit and just talk about some news and updates on Fannie Mae. Right, we had an updated forecast, another upward forecast, I believe. I tend to think along the same lines that we're going to see an improving production forecast, and actual is against that. Jodi, are you kind of tuned into that kind of side of the business still? I know it affects a lot of the things you're doing and a lot of people you work with. Are you kind of seeing the same thing?
Yeah, the more production that there is, the busier that I am, and the happier everyone is. So that doesn't change regardless on what side of the business that you are on. And we consistently talk about rates and where rates are going, and even we'll get into this when we talk about politics. And is what the focus hasn't been on is, it's like affordable housing, but it's affordable housing means inventory.
Yeah.
And I think the biggest problem to solve is housing inventory. It isn't, the bond rate has a rate cut in their heads. And interest rates, are going to come down some, but if you don't have homes to buy, it doesn't matter. So I think that needs to be more the focus. And, I usually feel like a pretty strategic thinker and can come up with solutions. I'll be really interested to see what comes out of FHFA as they talk about the tech sprint, and if there are if there's a magic wand to really help the inventory problem. I think that's the only way that we're going to see astronomical numbers in the future. It's not as much based on rate. And I think we're seeing that. I mean, home values are still not coming down because of lack of inventory. And especially it's different territories, different areas of the country you see. But for the most part, housing isn't coming down, and we're still running up against affordable housing. And I don't know how a family who makes $100,000 can own a home today. And if it isn't about, the inventory and the home prices, it's about the insurance and the areas that they're buying in. So I don't see a solve for inventory and creating affordability in housing. And that's what I'm afraid of with the administration, is if we continue to focus on potential, tax cuts for buying homes, we're only hurting the inventory issue that we already have more.
Right. KP, what?
Yeah.
I know you got a lot of
Money
thoughts on that.
Yeah, I mean, housing supply is going to be our challenge for years to come, and I think boomer wealth, boomer widows specifically are going to have $75 trillion of wealth in America, and they're just going to give their kids down payments. I mean, I have a property here in Newport Beach. I'm trying to get rented. It's been empty for a little over 2 months, which sucks, by the way. But we finally have someone flying down from Colorado. She gets $30,000 a month in, trust fund money, and so it's like, people have been accumulating wealth. And just to be clear, I mean, it takes time to accumulate wealth. But we can't help the affordable housing segment start their accumulation of wealth if we don't have something to sell them. And I fear that too, Jodi. I think it's a real, unless there's some disruption in the building space. I mean, I hear about manufactured housing a lot. I know that's great. The two biggest builders, they do a good job. They've got tiny homes. They've got 3D printed home initiatives. They're trying to get there and make it happen. It's hard to do it at scale.
Right.
It just is, and so, and then you throw on top of it, home insurance and taxes are going up. So, the only cure for, the affordable housing index is lower rates. And, maybe some government subsidies or some down payment assistance used properly can help. My wife, she took that, what was it, the Home Equity Recovery Act, the HERA money, where you got like a tax deduction for like 10 years if you bought. So, she bought, back in 08, I think, or 07, somewhere around there. So a house that she has in South Florida. And so it helped her open the door, and we still have that property. So anyway, I'm with you. The Fed can't solve it. We can't solve it. No, the government can try and help. But who's building houses, right? So I've got 3 projects currently on the ground as a fix and flipper. One is a 4-unit in Culver City that we're tearing down, building new, and then putting 2 ADUs on the back. And we're going to do 6 units. They're pretty small, but they're actually classified as affordable in Culver City. So that's 6 doors we're opening that we're going to build, rent, and hold. So, I mean, doing my part there. I'm doing my part on the birth-death ratio. I got 4 kids. I'm doing everything I can.
We just need like a million more KPs out there, right? Real quick on the just to kind of tie this together from the street, if you will, or from the voice of the consumer. We just did a deep study. We surveyed a bunch of users of our app, consumer users of our app, that were invited in by lenders. These were people that were early in their home buying process. Some actually completed the buying process, and we got them to spend 30 minutes with us with a company that we brought in, and just got a lot of great information. The number one stressor for these folks through their home buying process and journey was affordability and inventory. They felt like they got themselves to a place of financial readiness, but the rates still had them on edge, but yet there was no inventory. And so, I think this is a longer play, certainly, and it just also kind of aligns with Mr. Cooper and acquiring all these servicing assets. I think it's super important for loan officers in particular to stay engaged with your customers, and don't just rely on the campaigns that are running in your CRM. That's all good stuff, but you have to be engaged in a real way and having conversations, because the Mr. Cooper guys, they know how to retain servicing. That's what they do better than anybody. And so you have a way to beat them at their game if you're on the street as a loan officer, but that is you showing up, being visible, being present, and having conversations with your client base. And I think the same holds true for those early journey home buyers. You got to be in front of them, and you got to be in front of them in a meaningful way. Last thoughts. This is the literal last word. Jodi, what's your last word? What do you want to leave the audience with here this week? Whoops, you're muted. We can't hear your great voice.
No, I say stay optimistic. I do think we keep saying that there's light on the other side of the tunnel, and I really do believe that is true. And I think that for those who are in the industry, that a little bit of change is going to feel drastic. So we see a little bit, we'll get a lot more momentum, and once the flywheel starts rolling, it just keeps going faster and faster. So very optimistic about what's to come in first quarter of 2025.
Love it. Take us home, KP.
Well, so you were with me the last time I had an alcoholic cocktail that day, and we did a promo that there might be some cheers in here. So I'm just going to so faith, then health, then family, then career. Okay, that's our order of things here. I just completed yesterday a 30-day no drinking fitness challenge. You probably didn't even notice it; just went by. So I took my long drive arch from their educational series that we had up there, and I topped it off with some Centenario. So yeah, there you go. Hey, cheers to your health. If you have your health, you have everything you need. So I know it's a little early here. I'm just going to sip on this tequila. It's my first drink in 30 days. I just want to leave it for the last word. So
there you have it.
Pretty good. There you have
Enjoy.
it. So cheers to your health. Rates are down. They're trending down. We are in a good spot. This is a soft landing. Let's kick some ass. Let's go.